first big data point coming in today that we talked about. That is the Q1 GDP growing at 20.1%. This was on expected lines, expected because it's an unusual number. If you look at it in isolation, it looks like we've done great this quarter. But if you look at it in the context of what happened last year, because this is a comparative 20% jump. So last year in the same quarter, the GDP plummeted 24.4%, and that's because we imposed a nationwide lockdown soon after the pandemic hit. That nationwide lockdown pretty much froze all economic activity and led to a huge drop. So compared to there, of course, we've seen a significant growth. Now let's look at it in a more granular fashion and see what's happened. Now many are assuming, or many are now guessing, that if we had not seen such a bad second wave, this 20.1% figure would have been even better. But once you go into the details, you see that the farm sector continues to be a source of strength for the economy. It was even last year, if you remember, after the pandemic, at the worst of times, at least the agricultural sector grew 3.5% in that first quarter. This year it's 4.5% on that 3.5% base. The construction sector has seen great recovery. It dropped nearly 50% last year. In the same quarter, it's grown at 68.3%. The mining sector has also bounced back. And of course, momentum in vaccination is what is there to look forward to. But let's look at this in a bit more detail. I have today with me Pronab Sen, former member of the Planning Commission, and Dr. Devendra Pant, Chief Economist of India Ratings, on the show to help break us down. Welcome to both of you, and thank you so much for joining us on the India Development Debate. Mr. Sen, this evening there is this very strange debate going on about whether 20.1% is good. Is it great, or is it really nothing much? How would you put it into perspective?
Well, Tamanna, at the end of the day, what matters is how much income people in the country have. And essentially what the current numbers are saying is that in the first quarter of this year, Indians as a whole have got much less income than they had in 2019. Right now, do you take that as good news or bad news? Offhand, it looks like bad news, but compared to last year, it looks a lot better. But the simple fact of the matter is we haven't even gone back to base zero, which is 2019-20.
Right. Mr. Pant, clearly the numbers say it all. There's not much to interpret. We have done better than last year because of the low base. We are improving, but we've not gone back to pre-pandemic levels. That's pretty clear. But once you go into the details, what stands out for you in terms of the recovery story? And are we getting a sense of whether we have seen the second wave impact?
Yeah, Tamanna, there has been some impact of second wave. Had second wave not been there, and we would not have seen the localized and regional lockdowns, then we may be closer to the first quarter 2019 or first quarter 1920. These numbers have a lot of noise, so if we look at a YOY growth rate, that is not going to tell us anything. So we have to see, as Dr. Sen has also pointed out, we are 9.2% lower than first quarter of 2019-20 of April-June 2019. We were last year, 24.4% lower. From there, we had made a journey. But major question is, it's not a question of whether we have grown 20.1 or if pandemic was not there. We may have grown 25%. We may have achieved a level which was there in April, June 2019. But the major question is, and which we should be debating and looking at, what from here? Where are we going to go from here? Are we going to go back to that, what we had seen in the recent time, around 5 to 6% growth? Are we going to go down to 3.5 or 4% kind of growth? Now, there will be a number of permutation and combinations by which this growth rate may be achieved. So what the wages data is telling us, how the wages are going to are behaving, which has a direct impact on your consumption, because we had seen that cut in corporate tax rate with no demand or the very weak demand condition hasn't spurred the investment. So if you look at the investment, fixed capital formation is 17% lower than where it was April, June 2019. So these are the questions, or these are the issues which we should be debating, we should be discussing, rather than 20.1. That is what I feel. However, based on where we are right now, at least it does not give a confidence that we will come back to 6 or 7% growth in a short span of time. Now, whether if I look at 15th Finance Commission number, which they have put in the nominal GDP growth, which gives an indication even by 2023-24, we will be somewhere around 6.5% real, because they talk about 10.5% real, nominal GDP growth. So somewhere around 6.5%. So is it we are satisfied with? The answer is no. So I think that's what we should be debating and thinking about, how we can. Yeah, please.
Yeah. No, absolutely. So are we satisfied with a 5 to 6% growth? Clearly not. We've always aimed for a double digit. Are we satisfied that we are going back towards recovery? So clearly it's a matter of perspective. Pronab Sen, let me come back to the question of how long before we reach at least pre-pandemic levels. You made a very important point that at the end of the day, it's about the quality of lives of the Indian people, of the incomes they have, the access to healthcare they have, the kind of nutrition that we have, and then the kind of growth that we can see. It all comes down to that. So in those terms, looking at the kind of data which is coming in June and July, as well as the infection rates, would you say that we are moving closer towards the pre-pandemic kind of situation, and then from there on, we'll see how we grow?
Tamanna, this is difficult to say because, frankly, I mean, nobody can deny that the government has a huge role to play in terms of the recovery process, right? Now, those numbers now are starting to look a little worrying because, as you rightly said, the GDP has grown by 20.1%. But if you look at the production side, the value of goods and services produced, that's grown at only 18%, right? I mean, it's actually pretty low. The difference, the remaining 2 percentage points that we are talking about, has essentially come because net indirect taxes, which is the government's indirect taxes minus the subsidy it pays, has gone up significantly. So what is happening, and this is compared to 2019, mind you. Now, what we had expected is that during the course of the pandemic, the government would actually step up expenditures. It has stepped up expenditures, but not to the extent that was permitted by the tax collections. Now, this is something worrying. And these figures are being supported by the data that has been put out by the Controller General of Accounts, where we find, to our horror actually, that in this first quarter, government taxes have gone up by 2 lakh crores compared to 2019, but expenditures have gone up by only 0.5 lakh crores. Now, if the government is not going to support the economic growth, then I'm afraid Devendra is right. Yes, we will limp back because you're then depending entirely on what the private sector will do. And the data that we have from today's release, it simply reinforces that view that both private consumption and private investment are weak. So we shouldn't expect any dramatic change to happen unless the government steps up to the plate. And so far, it does not seem to have shown any inclination to do so.
Yep. So government spending needs to go up. Another aspect of how we will move forward and whether even this trajectory will continue is, of course, the rates of vaccination and whether a third wave will come. If it comes, how bad will it be? Mr. Pant, are you heartened to see 1.2 crore vaccines being administered in a day and over 50% of the adult population being covered?
Well, I think this is a matter of pride for all of us, whether we say that 20.1 is not sufficient, but when we are able to vaccinate 50% of the adult population, at least for a single jab, and maybe close to 12% or in excess of 10% double jab, that is the one thing which will push this economy or will take out this economy to a slightly better growth trajectory, because as more and more people will be vaccinated, then what you are saying, the contact intensive services, if we look, their performance is not good when we are looking at entire gross value addition growing by 18.1%. So that hasn't grown to that extent. If you look at trade, hotel, transport, communication, and services related to broadcasting, April-June 2021 is less than 70% of April-June 2019. Now, these are the sectors where you will find a lot of unorganized sector, and which has taken you can say in past few years they have been driving growth upward. And if the years and the time when the unorganized sector started having trouble, we had seen economic growth going down. So I'm again looking at, if I look at the household sector, how it has behaved over the last 4-5 years, and it maps with the growth slowdown which we had seen from last couple of years. So no doubt that is a good sign. More than 1 crore jab, I think twice in last 4 days or 5 days. That is encouraging sign. Whether it will be extremely difficult to vaccinate everyone by 31st December. But I think if we continue to grow like 60 lakh or between 60-65 lakh per day, maybe by 31st March, we will be able to vaccinate a large portion of our population. And once the activity starts increasing, people start moving around, that is only when we'll see how much legs do we have in this recovery. Do we reach closer to pre-COVID level?
Yep.
When we will reach closer to 2019-20 level, that will be a point to mark.
Right. So the vaccination is a key component of the entire story. The other big number that we talked about, 1.2 crore jabs in a day, no mean feat. Thank you so much, Pronab Sen and Devendra Pant, for joining us on the show and giving us a perspective on what that number, 20.1%, actually signifies. Well, the other number that we spoke about today is 17,000. So the Nifty has ended the month in style, breached the 17K mark, and just in 28 days, it's gone from 16,000 to 17,000. Clearly, this bull run in the market has no doubts in its mind on economic recovery, no concerns at all. Is it liquidity driven? Is it the retail investor coming back with a huge force? Or is the market looking at corporate numbers and feeling a sense of comfort? What really is pushing the markets up? Our managing editor, Nikunj Dalmia, is joining us in with his take.
Well, the parabolic or the hyper or the amazing bull market continues. In what I've reported in last 25 years of my television career, I have reported several bull markets, but this is a bull market like never before. In best of the bull markets also, we see periodic corrections of 5 to 10%. But this bull market, which started in April 2020, has not seen a 10% linear correction 18 months into its existence. And that's a global phenomenon. To give you a data point here, S&P is not corrected more than 5% at a stretch since November 2020, and this is August 2021. That's how the underlying power of the bull market is. The question is, where from here and why are we not correcting? One of the main factors why we are not correcting is because the fear hypothesis is getting challenged. Whether it was the view on the US Treasury yield, which is the linchpin of global capital and cost of capital, or the way the second wave was supposed to impact the economy, or the way how inflation and tapering would have impacted the fund flow. So none of the fear hypothesis, thankfully, has translated into reality, and that in a sense is one of the reasons why markets are chugging along. We are in a strange market where everybody wants a correction and the markets are not obliging. Now where do we go from here? The difference between the last 18 months and the upcoming days and weeks could be that the markets will rotate. If you bought into IT in the month of August, you're feeling like a bull market. If you bought into pharma, and if you bought into names like Aurobindo Pharma or a Shell or a Natco or a Dr. Reddy, you're feeling like it's a bear market. So the choice of stock selection, I think would be the primary differentiator going forward. In the near term, or perhaps in the month of September, we don't have any large triggers. So market action would be a function of macros and what will happen to the basic liquidity flow. The way I perceive the market is that it was a rising tide which took 90% of the stocks higher in last 80 months. And like I said, now it will be selective, which is 25% of the market will go higher, 25 to 30% of the market may do nothing, and remaining 15-20% of the market may actually start dwindling down. I think that's the demarcation is something which would be the differentiating factor in coming months.